Hello and welcome back, friends. Here in this module, we'll talk about value drivers and due diligence in private real estate investments. First, let's talk about value drivers, and we are going to start out with macro factors. Now, the macro factors affect the demand for real estate. Remember, the value is based on demand and supply interaction in that specific asset space, in this case, real estate. And so what are the drivers of demand? These include growth rate in GDP, employment, and wages. Now, growth rate in GDP, or overall economic growth rate, affects all different types of real estate. Other factors, such as, for example, employment or population growth, that may affect specific types of real estate, such as housing or residential rentals, or retail, meaning shopping malls, or changes in demographics. Another factor that could influence the demand for healthcare, for example. So these are all macro factors that influence the demand for different types of real estate. In addition to these macro factors, there are local factors, individual local environment, which influences the value of real estate in that locality. So these include a regulatory environment in that jurisdiction, in that municipal jurisdiction, whether the business climate is attractive or not, and the tax policies obviously affects the NOI. I'm talking about specifically property taxes. So those are what we call as local factors that affects the real estate in a specific locality, as opposed to nationwide impact, which is the macro factors. Now, let's look at a quick example of what happens to valuation of real estate depending on the outcome, meaning specifically what is going to be the impact on value on account of changes in market condition. So in this example, you are considering to build a 30,000 square foot warehouse building, or you're purchasing a 30,000 square foot warehouse building that will be refurbished. The current level of vacancy is 22% and the rent is $13 per square foot. Now you're given expenses, basically operating expenses such as property tax and other operating expenses is $78,000 per year, and maintenance expenses $21,000 per year. Cap rate is 4%. That is what is given to you. Now, these two specific elements, that's what we are focusing on in this example, the rental rate and the vacancy level. That varies depending on market conditions. So what if the vacancy rate is lower? Let's say it's 15%, and you see there is a negative correlation between vacancy rate and rental income. So when vacancies drop, when the supply is constrained, in those kind of scenarios, you see rental rates go inch higher. So here you are given with 15% vacancy, rent is expected to be $14 per square foot, $1 higher than normal. And if the conditions deteriorate and the vacancies rise, let's say it goes to 25% vacancy levels, then the rent will drop by $1